artificially lower rates. They quickly devour the immediate marshmallow in front of them, scoffing at the potential rewards for waiting. The lower rates make otherwise marginal investment schemes look good, and otherwise marginal existing capital, having marginal returns, look suddenly profitable, resulting in a scramble to own it and resulting in persistent market maladjustments. The system becomes starved of capital for roundabout production, as capital is trapped in the present, consuming itself as it were, and thus there are insufficient resources to support the ongoing illusion of economic progress. It only stands to reason that the stock market should inevitably fall, and fall in a violent, concentrated manner, as investors are routed into immediate liquidation altogether. Existing capital is priced too high relative to its ultimate profitability, and all the monetary delusions of grandeur are simultaneously revealed in a burst of highly correlated entrepreneurial error, when, in Mises's words, the airy castle of the boom can no longer buttress itself, and either rates rise from higher factor prices or from exhausted credit. It collapses on itself in a mass liquidation of malinvestment, a stock market crash, the homeostatic process in force. An auspicious and cathartic rout of malinvestment should then eventually produce an exceedingly low MS index, as the fire sale prices of titles to existing capital become unsustainably low. Capital will again begin its journey toward productive use, and its pricing is reorganized by the markets as they move back toward stationarity. Savings will necessarily grow again as rates finally reflect true time preferences, balancing the desire for and timing of roundabout investment, and immediate consumption will fall. The grand homeostasis reigns. Here we have the comprehensive Austrian setup for the ubiquitous violent twists and turns of the stock market and the economy, the events that the authorities and masterminds of the day always see as the unfortunate effects of hazardous and haphazard market forces, what have come to be routinely, though erringly called black swans. And this is our setup for Austrian Investing 1, whereby we swoop down like Sun Tzu's bird of prey, or better yet the Austrian eagle, when the moment is ripe and from a strategic position of advantage, and exploit these otherwise unexpected booms and busts. Witness to the distortion. Now for some housekeeping. As discussed in Chapter 7, the MS Index is very well represented by what is known as the Tobin's Equity Q ratio, total U.S. corporate equity divided by total U.S. corporate net worth, which is readily available online through numerous sources and easily computable using Federal Reserve flow of funds balance sheet data. And it is the height of irony that the very institution at the root of the distortion, the recognition of which is the point of the MS Index, provides the data necessary to calculate it. Figure 9.1 in the downloadable PDF shows the history of the MS Index going back to 1901. I have scaled it by its running geometric average, meaning it averages only data available as of each date, and thus removes any ex-post information. This scaling is meant to smooth any historical balance sheet bias. While we see a regular and orderly mean-reverting line cycling through history, the story it fails to tell, I might add, is the human misery and tumult and otherwise break on civilization's march suffered over the deep credit cycles displayed. This history depicts the clear footprints of historical monetary distortion. I regard it as pseudo-evidence of Austrian business cycle theory, ABCT, as academics struggle with empirically proving a misnomer, to be sure, ABCT. I argue they have simply been looking in the wrong places. The first obvious question to ask is, what is the subsequent effect of this distortion on the replacement value of all the capital valued in the numerator? That is, to what extent have higher expected profits in the price of title to existing capital been subsequently imputed into the source of those higher profits? Shouldn't high MS index levels above 1, for instance, logically lure profit-seeking entrepreneurs into greater capital investment, such that their successive efforts raise the replacement value and accumulated magnitude in the denominator, and thus offset the rise in the numerator of the MS index? In fact, there is absolutely no statistically significant or consistent relationship between MS index levels and subsequent aggregate capital investment, visible neither in changes in aggregate capital expenditures as a percentage of invested capital, nor in changes in aggregate corporate net worth, the denominator of the MS index. Much to the chagrin of the meddling central bankers, only the stock market is reliably affected, and only for a time, by monetary interventionism. In other words, when the central bankers try to stimulate actual physical investment by goosing asset prices with loose money, they fail to achieve their goal. The result puzzled Tobin and other Keynesians, as mentioned in Chapter 7, and might have even surprised Mises somewhat before applying his entirely correct theory of malinvestment to Baumbacherk's earlier insight on myopic time inconsistency and to real-world interest rates. Any alternative explanation for this history of the MS Index, such as the existence of psychological animal spirits driving economic booms and busts, must explain how this irrationality applies only to the stock market, but not to its components, that is, only to the whole, but not to the sum of its parts. How are equity holders, the owners of capital, the factors of production, specifically and highly segmented from those who further build new capital, new factors of production? This is a far more dubious proposition than simply saying that assets are expensive, as apparently only certain assets are expensive. The next and most pertinent question: what is the real effect of this distortion on the numerator, the aggregate land expectation value, if this were taking place in our Nibelungenland, and the aggregate stock market capitalization in our real economy? Let's start by examining the total excess returns, the return including dividends, in excess of the one-year risk-free treasury rate of the S&P Composite Index, the biggest, most closely watched, and most heavily traded and well-recorded capitalization-weighted U.S. stock index, a very good proxy for the total corporate equity of the MS Index, following different regimes of monetary distortion since the turn of the 20th century. I throw each annual return data point on the S&P Composite into 1 or 4 brackets based on the MS Index at the start of each one-year period. In Figure 9.1 of the downloadable PDF, the first bucket, on the far left, corresponds to the lowest quartile, or lowest 25%, MS Index readings, the second for the next higher readings, the third for the next, and finally the fourth bucket, on the far right, for the highest quartile MS Index readings. I then take the average of the excess returns in each bucket to see simple expectations for each MS Index level. All returns are total excess returns, including dividends. The error ranges around each bar, depicted by the vertical lines with hash marks at each end, are 95% confidence intervals of the sample statistics, found through a non-parametric bootstrap. This same methodology is used throughout this and the next chapter. Based on what we now know, we could expect to see an inverse relationship. When the MS Index is low, the subsequent average stock return should be high. When the MS Index is high, the subsequent average return should be low. If we didn't observe this outcome, it would mean that somehow investors responded to lower rates with more new capital investment, and this new investment, as well as the old, remained, on average, profitable after rates normalized, an impossibility. The data cooperate. With greater than 95% statistical significance, my conjecture, derived from Austrian theory, is right. What's driving these return differentials? Do stocks merely drift up at steeper rates under low MS Index levels than under high ones, or is there something else going on? Of course, we would expect to see the indications of severe malinvestment liquidation driving these results, meaning severe subsequent stock market losses, and we'll look at the concentration or speed of such losses a bit later. In the following test, I use S&P Composite Index drawdowns, or the amount by which our S&P returns cumulatively turn negative during any 3-year window before rising again, as a measurement of stock market losses. In bucketing these drawdowns based on the MS Index at the start of each period, just as I did in Figure 9.2 of the downloadable PDF, we start to uncover the market's dynamics. In Figure 9.3 of the downloadable PDF, the lowest dark bar indicates the 20th percentile drawdown, or the realized drawdown at which 20% of all the data in the bucket are lower, and the light bar above the dark bar is the 50th percentile, also called the median drawdown, or the realized drawdown at which half of all the data in the bucket are lower. Error bars indicate 95% confidence intervals around each percentile estimate. Going back over a century, this looks pretty bad for capital investment following high MS Index levels, and for low MS Index levels there really wasn't much to worry about. Imagine that. What a financially distorted world tells us is that the market, just like the overgrown forest, carries within it the seeds of its destructive correction. Thus the inevitable bust that follows the boom is not, or at least should not be, an unexpected event. This is a very important realization, something of a death blow to the concept of systemic risk, and which will become the backbone of the Austrian Investing 1 rationale, and without which we would be left as mere victims of the distorted market and seemingly random shocks. The Austrians were right before the time of this data. Just as we saw in Nibelungenland in Chapter 7, the undulations of the business cycle, as reflected in the stock market, do indeed simply follow a pattern of correcting persistent inflationary departures from stationarity. An initial Misesian investment strategy. What would the assumption of the validity of this simple idea have done for an investor in the U.S. back when the Austrians first formulated the principles behind it, starting 100 or so years ago? Let's put this to the test, a tremendous century-long out-of-sample test, truly free of hindsight bias, of the deductive a priori Austrian capital and interest theory. Let's consider what one might do with just this robust information on the existence and effects of distortion, for which, obviously, we didn't really need the tests presented earlier. Let's become greedy capitalists, licking our chops, crossbows drawn, and wondering how we can make money from this knowledge. To start, the simplest back-of-the-envelope strategy would be to buy when the MS index is low and sell when it is high. I'll call this our Misesian investment strategy, in honor of the man whose approach was to avoid the systematic collapse of the 1930s. A version of this strategy has, of course, been identified by others before, and what investment strategy hasn't? What matters here is the conceptual thinking, the identification of the edge, or, in this case, the imbalance behind the strategy. Here we are playing the explicit role of our pedagogical conifer, anticipating and exploiting through circumvention the roiling wildfire and resulting nutrient-rich soil. A quick and dirty scan of the MS index chart, figure 9.1 in the downloadable PDF, tells us that, say, a reading of 1.6 and, say, of 0.7 were historically generally high and low levels, so likely good places to sell and buy stocks, respectively. And when we've sold out of our stocks, we buy 1-month treasury bills and roll them each month until we buy back into the stock market. How would that have done? There is a good deal of ex-post information in this strategy, because we didn't know what constituted a good MS index level at which to sell or buy until it was all over, of course. However, it turns out, not surprisingly, that's not a concern. If I instead start my test after, say, 1925, the first complete cycle, rather than 1901, and use only the information known at the time from then on, I get equivalent results, no cheating. As my old mentor Everett Klipp would have advised, our methodology here is exceedingly simple, again dubiously so. But there is great beauty and effectiveness in our simplicity. See figure 9.4 of the downloadable PDF. The Misesian strategy outperforms the stock market by more than 2 percentage points per year. Think about what this shows. A basic toy strategy with an alpha t-score of well over 4, based solely on an easily calculable and logical measure of market distortion, beats not only the average professional stock picker, who consistently underperforms the S&P, but also the highly survivorship-biased average hedge fund manager, such as from the HFRI Fund Weighted Composite Index, and with far less fanfare and risk. And for the record, while others have made attempts at Austrian market indicators of all sorts, none to my knowledge has either had these results nor avoided the lures of arbitrary ex-post fitting and spurious relationships. The properties of the MS Index offer a logical, straightforward, and highly pragmatic guide that most people can follow and understand, acting as a very simple gauge to judge one's investment theses. And yet, it still seems to elude most people. After all, very few people, including professionals, get these kinds of investing results over time. The reason, as you've probably deduced by now, is that these returns are only realized in an exceedingly roundabout way. The detour beats the direct route. That is, it takes the Misesian strategy's average underperformance duration and magnitude of almost 3 years and 9% annualized to gain the advantages of investing for its eventual 2% cumulative outperformance. Just imagine still waiting today after 2 decades to re-enter the once again booming stock market. It painfully sacrifices immediate profits as markets become more and more inflated by artificially low rates, most of the time for a tremendous eventual advantage in buying after they inevitably deflate. It is investing Wei Qi style. In the immediate marshmallow world of investing, it is so hard to be the one sitting with folded arms, not taking the sweet enticement of now, and focusing instead on intermediate means for positional advantage to be exploited later. In Wei Qi, it takes great discipline to be sure, building only potential that may or may not ever really materialize, while one's Li opponent racks up points and appears to be winning by a sizable margin. Yet it is a choice that we must make to take on the roundabout burden of the indirect, retreating now and looking foolish or worse to the rest of the world. Klipp used to have a pithy phrase that embodied the difficulty of being sure in a Li world, saying to be successful in trading, one had to look like a jerk, feel like a jerk. Though, what else would we expect from the man who said you had to love to lose money and hate to make it? Given all the time we've spent in the esteemed company of Lao Tzu and Sun Tzu, Bastiat and Clausewitz, Menger, Böhm-Bawerk, Mises, and Ford, why would we not want to apply this thinking for ourselves? Not to do so would seem the ultimate foolishness, to turn our back on this archetypal strategic wisdom. If you are wondering right now, after 8 chapters of the roundabout, if the first investment strategy you are receiving basically tells you to stay out of the market for long periods of time when distortion is running high, the answer is yes. Although that may seem anticlimactic, it is anything but. To put this in the most straightforward terms, it's a really big deal, a very different and contrarian and highly effective way to approach investing. Just as Klipp's paradox of love to lose money, hate to make money, led to incredible discipline, and some healthy returns in the trading pit, so too does this Misesian approach in anyone's portfolio. The objective of roundabout Austrian investing is not to find a way to make money now, but to position ourselves for better investment opportunities later, or as we might state it, we're being patient now, so we can be strategically impatient later. Whatever you decide to do as an investor, keep in mind the overarching aim of this audiobook. It is about a way of thinking, of understanding the roundabout and the considerable strategic advantages to be gained along the patient, circuitous path. If you take away nothing else from this chapter, or even from this audiobook, know that there is usually imminent danger in the direct approach, in ignoring the means for the ends, particularly in the market when distortion is running high. Thanks to the Misesian Stationarity Index, there is a way to gauge that danger so that, no matter what your investment decisions are, you are better informed about those dangers. Implementing this cookie-cutter Misesian strategy is extremely ambitious, even audacious, particularly for professionals, as Chapter 6 reminds us, because of that humanness about us that gives us a high immediate time preference, further magnified under monetary intervention, and makes it difficult to impossible to forego the immediate marshmallow, even though we may believe there are a great many more marshmallows to come. Think of the Misesian Wall Street investor, an oddity to be sure, who shows no excess return during the distortion years when he owns low-yielding T-bills and dramatically underperforms the stock market as it further runs up. He and his ilk would have mostly been weeded out by natural selection over a year or two of underperformance. No uber-hyperbolic discounter will ever get to monetize the 2% outperformance of the Misesian strategy, though he would be a wealthy star if he could. Hyperbolic discounting requires enduring a difficult wait, which is most intense in the earliest steps, from today until tomorrow, from tomorrow to the day after, and so forth. We perceive that the wait will get easier with each step, but that doesn't help us over the next step, particularly if interest rates have been manipulated all the way down to zero, and everyone is piling into the stock market. As stated earlier, our sense of immediacy is made all the more acute, paradoxically, by monetary distortion, feeding an ever-shortening investment horizon. If everyone could steel themselves against the temptation brought on by the distortion, or if humans were robotic exponential discounters, and all capital were the same homogeneous blob, then distortion likely wouldn't even happen. To succeed, we need the fortitude of Mises, who turned down a lucrative job with the prestigious Kreditanstalt Bank, saying he wouldn't be part of the great crash to come. We too need to distance ourselves from the distortion, so that we do not become suckered in by it, which will lead to the opposite of what we intend. Buying when the MS index is high and selling as it falls, which, rather than the roundabout path to capital accumulation, is the direct path to capital destruction. There is yet another challenge in executing this Misesian strategy. It requires contrarian thinking, a not to be underestimated psychological feat, to zig when the rest of the world is zagging, to step aside when the rest of the world is scrambling to buy, and to buy when the rest of the world is bailing out of positions. When the MS index goes so low it falls well below 1, then one can act like a corporate raider, particularly common around the last generational low in the MS index in the early 1980s, scooping up good assets that can then be liquidated at a profit, because in the aftermath of a malinvestment purge, title to capital is available for less than the replacement cost. Think of a low MS index for a cash-rich investor as an analogous to the no longer dormant conifer seeds after their serotinous cones have opened, ready to spread throughout the fire-cleared, competitor-free land, enriched by nutrients of their vanquished predecessors. The Eagle and the Swan. The sudden realization of mass-correlated entrepreneurial error is Austrian speak for stock market crash, as most, if not all, companies suddenly are revealed to have been priced wrong, and many are engaged in, and now looking to quickly exit, projects that one minute were considered profitable and the next not. This is, of course, the retreating route, to be followed by the counter route. How can this happen outside of the distortion described in Nibelungenland? Everyone continues to scratch their heads over this. Many are quick to become financial ornithologists, crying black swan as per Nassim Taleb's wonderful book by the same name. A black swan, or tail event, is an epical event, big and extremely rare, or better still, has never yet even happened at all. The word tail refers to the outermost and relatively thin tail-like appendage of a frequency distribution, or probability density function. The 1st and 2nd century CE Roman poet Juvenal is credited with coining the term black swan in reference to a decent wife, a rare bird as strange to the earth as a black swan. Any spousal ire over that comment should be directed at Juvenal, not at this author. Black swan, as the code words for an unexpected event, the discovery that not all swans were white as once believed, was promulgated in the early 20th century by Viennese-born philosopher Karl Popper, who taught at the London School of Economics. Popper and rival Ludwig Wittgenstein, who famously argued over sundry philosophical problems, were major forces in the intellectual prowess of early 20th century Vienna. When they occur, stock market crashes seem so irrational to most, so haphazard and unforeseeable, so black swan. But are they irrational? Are they even unforeseeable? Or do they simply stem from the distorting effects of credit expansions, as the Austrians suggest? We have already seen, in Figure 9.3 of the downloadable PDF, that severe stock market losses, what I've called drawdowns, follow periods of great distortion. While accumulated losses are likely the only crashes that matter, after all, it is the extent to which stock market losses accumulate that they are economically important. Let's nonetheless take this a step further and look at temporally concentrated stock market losses, those that occur over a month, for instance, selling routes. I'll actually use 2-month returns in order to best capture non-calendar monthly swings. These should be the true mark of a distorted world, since the end to the distortion is a sudden revelation as interest rates rise or credit evaporates, not a slow, orderly correction. If it were the latter, it would presumably be correctable through ordinary entrepreneurial adjustments. Over the past century plus, there have been sizable monthly losses of 20% or more in the aggregate U.S. stock market, and they have occurred with exceedingly low frequency. By definition, therefore, it would seem we should be able to call such crashes in the stock market tail events. But on closer inspection, a different story emerges in Figure 9.5 of the downloadable PDF. Upon bucketing 2-month returns by their starting MS index quartiles, over a 3-year window of overlapping 2-month returns following bucketing, and calculating the 2nd and 5th percentiles in each bucket, we see again that crashes follow distortion. This is just as was done in Figure 9.3 of the downloadable PDF, with 20th and 50th percentiles of all the cumulative drawdowns. Only here I'm looking at 2nd and 5th percentiles of all the 2-month returns, meaning in the case of the 2nd percentile, the realized 2-month return at which 2% of all the 2-month return data in the bucket are lower. Error bars once again indicate 95% confidence intervals around each percentile estimate. To put Figure 9.5 in the downloadable PDF into perspective, with 2% of 2-month returns having been even worse than a 20% crash during the high MS index quartile, the lowest dark bar in the 4th bucket on the far right, one could expect to wait around 50 months as the expected number of random trials needed to get an outcome with a 2% chance on each trial, for a greater than 20% 2-month crash to occur when the MS index is in this highest of ranges. Clearly, 20% or worse crashes are not the random 100-year flood as people generally think. They happen fairly quickly under certain conditions, a very distorted MS index, while those conditions have happened a handful of times over the past century. Moreover, they happen much less quickly, and one would in fact still be waiting following a low MS index. Once again, with such sound Austrian logic behind these studies, the evidence of distortion and its ramifications to investors is overwhelming. When the MS index is high ex ante, subsequent large stock market losses and crashes are no longer tail events at all. Rather, they are perfectly expected events. To Austrian eyes, these epochal losses were not unforeseeable. More alarmingly, due to the evidence of monetary credit expansion of late, visible in the MS index in Figure 9.1 of the downloadable PDF, as of this writing in July 2013, we have no right to be surprised by a severe and imminent stock market crash. In fact, we must absolutely expect it. For the record, our discussion of black swans here is confined to events as registered by the stock market. Should an asteroid come hurtling at us from the depths of space and strike us unawares, then maybe we'll chalk that one up to a black swan. However, stock market plunges that have occurred over the past century most certainly were not black swans or tail events. When it comes to events such as the crash of 2008, we see instead a bird of a very different feather, the Austrian variety. What we have here is an induction problem of vantage point, such as Bertrand Russell's chicken that is surprised to have its neck wrung, by the very farmer who has been lovingly feeding it all of its life. The common epistemological problem is failing to account for the possibility of a tail until we see it. But the challenge here is something of the reverse. We account for visible tails unconditionally, and thus fail to account for when such a tail is not even a tail at all. Perhaps the scientific and mathematical methodology, the physics envy of Chapter 7 of modern economics and finance, is at the very source of the perception problem. A mainstream economist will typically model stock price movements such that a tail event, by definition, is bad luck. Every serious student of mathematics and finance recognizes the naive simplicity of the Gaussian bell curve, loosely speaking, assumptions underlying standard economics and finance models of the markets. But I am claiming here that the solution is not to come up with even fancier probability distributions. The deeper problem is the treatment of the return in the market as a number given to us by capricious nature. Despite the apparent tremendous uncertainty in stock returns, they are most certainly not randomly generated numbers. Understanding tails would be tricky matters if they were, as we know from the deceptive small sample bias of power law distributions, for instance. Stock markets, however, are so much richer, grittier, and more complex than that. Why shouldn't the price of immediacy jump to infinity along with perceived demands for immediacy? Why should anyone be expected to accommodate a burst of counterparties at prices that are strongly and suddenly believed to be in error, to accommodate the liquidation of malinvestment? After all, to assume anything else would be to assume that liquidity providers are charities. The black swan notion is still paramount, however. I named many of my investment partnerships after it, but only because of the vantage point perception problem. Truly, the real black swan problem of stock market busts is not about a remote event that is considered unforeseeable. Rather, it is about a foreseeable event that is considered remote. The vast majority of market participants fail to expect what should be, in reality, perfectly expected events. Intertemporally challenged and further blinded by a myopic focus on the now, they price in only Anglo swans, missing the Viennese bird lurking conspicuously in the weeds. Case Study: Prototypical Tail Hedging. We are now ready to transition from the simple Misesian investing strategy to Austrian Investing 1. In so doing, we return, in essence, to Marco at McElligot's pool, although his gear to catch thingamajiggers has been upgraded considerably to highly sophisticated harpoons, put options in our case. In the second phase, Austrian Investing 2, we switch from Marco to Siegfried, that intrepid Wagnerian dragon slayer and Nibelungen entrepreneur, whose activities are less susceptible to distortion, and who represents the true advantage of the roundabout. When distortions and imbalances in the aggregate capital structure come to an end, by necessity, it happens so ferociously, due to the surprise of entrepreneurs across the economy as they simultaneously discover that they have all committed investment errors. Rather than entrepreneurs serving their homeostatic function of correcting maladjustments, the entire market must adjust itself abruptly through an essentially simultaneous liquidation. What follows in the eyes of those who couldn't see the distortion is a dreaded tail event. If the market perceives, or rather prices, a large loss in the stock market is very unlikely, even when such perception and pricing are unwarranted. Obviously, tremendous opportunity exists, even if only to protect a portfolio against such deleterious losses. The test depicted in Figure 9.5 of the downloadable PDF was perhaps just a crude, though perfectly robust, they tend to go together, way of measuring the negative tail of monthly equity returns. There are endless other ways, ranging from the maximum likelihood hill estimator to log-log regressions of fractal dimensions, all of which show essentially the same thicker tails under higher MS index levels. In measuring the profits had by tail hedging, we, in fact, now have what I regard as the most economically intuitive and comprehensible method to measure the dreaded tail. In so doing, I will simultaneously thus illustrate the Austrian Investing 1 methodology. I present an analysis of a simplified, prototypical tail-hedged equity portfolio. In this discussion, I move from the commentator I was in previous chapters to practitioner. Tail hedging, or Austrian Investing 1, is at the center of what I practice in my investment partnerships, and Austrian Investing 2 of Chapter 10, in combination with Austrian Investing 1, is what I practice in my family office. However, while this is something of a glimpse into what I do in my funds, my actual approach is far more nuanced, as it is far beyond the scope and intention of this audiobook. It bears repeating. I am not telling anyone to run out and do this as described. Even the very generic version of tail hedging is very hard and involves options that are very illiquid, which makes pricing and taking profits very difficult. Nonetheless, This part of the discussion is meant to serve as a conservative and honest case study, the purpose of which is, beyond further measuring tails, to demonstrate Austrian tools and the application of the roundabout approach through the conditional historical outperformance generated by adding extremely out-of-the-money puts to the S&P Composite Index. To begin with a little basic knowledge for listeners who are not familiar with options, a put is a derivative instrument that gives the holder the right but not the obligation to take a short position in the underlying security at the strike price, e.g. an equity index such as the S&P Composite. With tail hedging, the puts involved are necessarily, by definition, extremely far out of the money, meaning the strike price at which they become exercisable is very far below the current market price. The portfolio I am testing in this study purchases 2-month 0.5 delta puts on the S&P Composite Index, approximately 30% out of the money, in the case of a 40% implied volatility, at the start of each strategy period at an assumed 40% starting volatility level, which is a historical median pricing level. And in fact, within a large range, the return outperformance levels reported are surprisingly robust to this pricing level. After every month, the 2-month put options position is rolled. The existing options are sold, and new 2-month puts are purchased, which resets the position every month. A historical conservative interpolated mapping is utilized, which maps monthly index returns into concurrent monthly changes in pricing, or implied volatility, of the 2-month puts for monthly vega profit and loss, as well as changes in the pricing spread between 1-month and 2-month puts for monthly rolling. This mapping allows the test to include time periods before data are even available for options markets, thus providing a much greater range of market environments. Each month, the portfolio spends 0.5% on puts, and the remaining 99.5% stays invested in the S&P index. No leverage is employed, and in fact, typically when the market is down by not even 20%, the entire portfolio is actually net profitable. Each strategy period encompasses 2 years of returns, and outperformance measures are annualized and bucketed into quartiles according to the MS index level at the start of each respective period. The periods tested range from 1901, when the MS index data is first available, to the present. The outperformance mean and 95% confidence interval of the mean are calculated for each MS index quartile. All returns include reinvested dividends. The case study compares the returns when tail hedging is used versus only owning the S&P to determine if and when outperformance occurs and its magnitude. As figure 9.6 in the downloadable PDF shows, with more than 95% statistical confidence, just as we saw in figure 9.5, not surprisingly since both use essentially the same monthly return data. The benefits of tail hedging are highly conditional on levels of distortion as evidenced by the MS index. When the MS index is in the upper quartile, as it is as I write, there has been an approximate 4 percentage point outperformance of the Austrian Investing 1 strategy, or a tail-hedged index portfolio over only owning the index, an outperformance that fades as the starting MS index level falls. Thus, there is a third choice between owning stocks or cash, as in the basic Misesian strategy, in a high distortion environment. Indeed, when combined with the expected excess returns of equities alone shown in figure 9.2 of the downloadable PDF, it is clear that a tail-hedged equity portfolio is superior to any of the investment industry's misplaced fine-tuning between equities and cash only. This is the roundabout Austrian capitalizing on the fact that investing in far out-of-the-money puts requires intertemporal vision, an indirect route, the likely loss and the immediate, as that 0.5% spent on puts is lost each month without a crash, to achieving a later potential gain, the eventual profits from the puts, which are then invested in stocks whose subsequent returns will be much higher. Of course, those monthly put costs pale in comparison to the opportunity costs of being uninvested in stocks in the Misesian strategy. Each option represents a seed in time, a chance for the giant redwood to put down roots into future fire-scorched land. What to most is an immediate sunk cost, a capital investment in what seems unlikely at the peak of the boom to be a potential future crash in the making, is potential to the savvy Austrian investor in the context of his portfolio, both in the profit from his put options and the future compounding returns, new trees, to come from investing in a resulting low MS index environment. Clearly, expecting a market purge need not be a doom and gloom approach. It is rather a tremendously opportunistic, optimistic approach for one with capital, means, in such an environment, specifically when malinvestment is being liquidated and the MS index becomes exceedingly low. Capital is not destroyed, rather, title just changes hands at more advantageous prices to the buyer. The obvious takeaway is the benefit to investors who have access to effective tail hedging. However, seeing only that conclusion misses the far larger and more important point to understand: the source of this edge. As we know, both deductively and now inductively, from Figure 9.6 of the downloadable PDF, the edge in the tail hedging strategy is driven by monetary distortion. I would argue that systemic tail hedging wouldn't be nearly as important, and probably not necessary at all, if it weren't for the distortion. The fact is, the many people who make predictions about the goodness of tail hedging as an asset class, something inconceivable as recently as when I launched Universa in 2007, without any thought to the environment of monetary distortion or the intertemporal effects on their investment decisions through time, are missing most of the story. When the MS index is high, tail hedging further becomes expected event hedging and provides the investing means for when the MS index is low. The ZEAL and the ZVEC, central bank hedging. I have shown that the epistemological problems of black swans and tails can be quite advantageous, both in the Misesian strategy and most notably in Austrian Investing 1. An extreme loss in the stock market is certainly priced into much of the equity derivatives markets as an extreme tail, i.e. extremely unlikely, despite such overwhelming evidence to the contrary. I cannot fully explain why this is, just as I cannot explain why the Austrian school remains, in Mises's words, the somewhat reluctantly tolerated outsider. But, given that the two are inherently one and the same, we should not be surprised. From the face of it, it is impossible to come to predicting or even understanding the properties of the most severe and rare events by extrapolating what we have already seen. There is a fundamental perception problem at the heart of this problem, a distributional illusion that can be shattered in an instant. Some may find this paradoxical coming from me, known as I am for tail hedging and so-called black swan investing. From my view, empirically and from a priori Austrian interpretation, black swan events have been largely insignificant in at least the last century of capital investment in the United States, including the most recent crisis. Investors have, indeed, encountered surprising and pernicious events, but the fact is, those who were surprised have been those in the extreme majority, with either a blind or brazen disregard for the crucial concepts of Austrian capital theory and monetary credit expansions, and the corollary understanding of capital goods and the time structure of production. Of course, this does not mean that catastrophic free market capitalism destroying events, either man-made or not, couldn't have happened, and the man-made variety has historically been entirely related to the interventionism discussed in this audiobook. We are dealing with the realm of entrepreneurial action within a competitive economic system and the monetary distortions that affect it. But note that during the 100-plus years of this study, there was much devastating, unprecedented world conflict, including 2 world wars, which were still subsumed by Austrian praxeological principles when looking at equity market returns. It seems that tail hedging, as I have been explicitly practicing for about 15 years now, should be called central bank hedging, or better yet, as I have coined the term, Austrian Investing 1. This activity over my career likely would have been much less interesting and fruitful without the insights of Mises and the cooperative actions of Federal Reserve Chairman Greenspan and Bernanke, to which I note with my hearty thanks, Danke schön, meine Herren. Wir sind jetzt alle Österreicher. Austrian Investing 1 is thus the autocatalytic process of indirect tools begetting greater tools, of profitable positions, which then beget even more profitable positions, a roundabout investment process. Puts are just as much about reinvesting cash at a market low as they are about making money on the path down to that low. Austrian Investing 1 and 2, which are encompassed here and in Chapter 10, respectively, both of which attain the ability to deploy capital where and when it is most productive, and then actually do it, are the destination toward which this audiobook has been aiming all along. Although the thought process is the important takeaway here, there are demands and perhaps even a requirement for investment books to provide action items. In the Misesian strategy discussed earlier, we switched between 2 choices, profiting from both a full equity position when the MS index was low, and avoiding drawdowns with a full cash position when the MS index was high. This 100% Treasury bill position provided a roundabout position of advantage in a future period to be deployed as potential investments in titles to capital, i.e. equities, when the price of that capital is much lower, and thus its subsequent productivity and returns are much higher. The use of puts in Austrian Investing 1 is but a logical and even more effective progression from our simple cash position, a somewhat more refined sure strategy. This is the ultimate game of Tuichot, where yielding to the initial route is an intermediate step of Zhou toward the counter route of buying cheap title to productive capital and following, or nian soi, the market back to stationarity. As effective as the option trade is, it is but the prelude, an intermediate waypoint toward an even greater edge, an attack and counterattack. In the option trade is the temporal coordination of capital with its most advantageous and opportune use. The put options that comprise our tail hedge serve not only to provide even more liquid capital in a route for reinvestment, but also allow a large and even full investment in stocks during the distortion. Think of it as a fast-growing angiosperm with the serotinous cones of a conifer. It seems the stock versus cash decision of the basic Misesian strategy and of virtually all asset allocation decisions and a good bit of academic research is entirely misplaced with the availability of other such Austrian tools. The positioning of puts is the thingamajigger harpoon of Marco, the advanced tools, building blocks, or intermediate links, the Clausewitzian Handeln, leading up to the effectual principle, but never as that principle itself. While generating profits from the hedge is its aim, its zeal, that is not the intended end. The profits are but the first stage of this roundabout investment scheme. The second is what is done with those profits within a world in which distortion has suddenly been burned away. Thus, the put positions are the mittel for the zweck of highly productive capital investment, the superior technical productivity of means employed toward ends. The roundabout investor. Admittedly, investing based on MS index levels to take advantage of distortion is not roundabout in the Bombaverkian sense of things. Eugen von Bombaverk did not discuss distortion, but it is roundabout in the Austrian sense because of its alignment with Umweg and its Daoist counterpart, Schur, in that our investment goal is to maximize our investment edge at some particularly advantageous intertemporal points in the future. Thus, we are using time, or more specifically, roundaboutness, to attain higher capital productivity. Although our case study shows the importance of tail hedging, as we look at it on its own merit, we remind ourselves that we cannot confuse it with the zweck, the end goal in itself. For me, the hedge is a zeal, an intermediate objective, a waypoint of advantage along a roundabout path known as Austrian Investing. With this perspective, we can also see a link between Austrian Investing 1 and the basic strategy presented earlier in this chapter of avoiding the market when the MS index is high and exploiting the market when it is low. The commonality of the two strategies, one to pinpoint when to avoid the market and the other to exploit the distortion, is the importance of preserving and generating capital to be deployed opportunistically later, when the moment is right. Thus, tail hedging is, indeed, sure, becoming the means and setup for strategic positional advantage, a fully loaded crossbow with extra arrows in the quiver, to be fired later when the vulnerable target appears. As such, tail hedging is a tool that allows us to actually exploit the distortion and not succumb to it. Now, in the next chapter, we hear what real investment in capitalistic production is all about, as we gain a full appreciation of what is so special about this process. And so from Austrian Investing 1, insulating ourselves from the trap of distortion and even profiting from it, we move on to Austrian Investing 2, which is grounded in the wisdom of Bombaverk's roundabout and straightforward lesson, thanks to the Austrians, of how to invest in such a manner. We take a page out of the Austrian classics as we accumulate the means of production and heed the entrepreneurial charge. Thus, as investors, we become fully Austrian in thought and action. Chapter 10. Austrian Investing 2, Siegfried, Exploiting the Bombaverkian Roundabout. The roundabout route, leading first to an intermediate point, a zeal, from which to launch the next campaign in pursuit of the destination, the zweck, is the roadmap for Austrian investing. On the first leg of this journey, as I laid out in Chapter 9 with Austrian Investing 1, we focused on the distortion in the financial markets, indicated by the telltale sign of an MS index significantly higher than 1. Recall that this signal tells us that the physical structure of production of the real economy has been, through monetary sleight of hand, coerced away from stationarity, and is poised to snap back again as the forces of negative feedback become even stronger. Once we have identified such a scenario, we can exploit our knowledge, elusive to most, and known only through study of Austrian theory, through two basic responses. We either can keep our capital on the sidelines in reserve, what I have called the basic Misesian strategy, or we can enter positions that opportunistically generate capital when its deployment is most effective, the more sophisticated complement of tail hedging, and what I call Austrian Investing 1, sure strategies all. Now, in this chapter, we are ready for the second part, where we seek out opportunities that are aligned with the true Bombaverkian roundabout of the Austrian Unternehmer. Rather than gauging the stationarity, or lack thereof, of the market as a whole, in Austrian Investing 2, I zoom in on the individual firms and their exceedingly heterogeneous capital, moving from the macro to the micro, which is only fitting for an investment philosophy bearing the name Austrian. In so doing, we deploy all the tools we have amassed thus far to scout out and capture those rare roundabout investments that will make us truly Austrian investors. As always, we are guided by the Austrians' principles of parsimony and fidelity to reality. That is, they say only what they can say in simple tautological language, as opposed to the convoluted mathematical models of the mainstream, with the fewest inputs, if you will, which leaves them extremely constrained. By restricting themselves to qualitative but necessarily true statements, the Austrians often come under fire, even today, as being quaint or medieval. Yet they avoid the false precision that plagues the smartest guys in the room, who built impressive and clever computer models of the financial markets that seemed to predict just fine, until they didn't. Needless to say, this hyper-precise modeling approach, which characterized long-term capital management and other strategies cooked up by the mathematical experts, is diametrically opposed to our uniquely Austrian methodology. Just as I stated in Chapter 9, only the thinking behind Austrian investing can validate it. An investment strategy that seemed to work on the historical data can famously disappear, assuming it was not a spurious mirage in the first place, as soon as analysts become aware of it. This is one of the central findings in the efficient markets literature. But in this audiobook, I have used deductive Austrian reasoning to explain systematic forces of disequilibrium, and our logic also explains why other presumably non-Austrian investors, having a distinct humanness about them, will leave the proverbial money on the table. Our look at the data indicates not the truth of the underlying theory, but rather it shows us the magnitude of the potential gains. The historical data show us the importance of our theoretical deductions. Roundabout investing, a very apt synonym for Austrian investing, is all about the temporal structure of productive capital. As we recall from the slow-growing at first conifers and Henry Ford's capital structure extending from raw materials to automobiles, production by its very nature takes time. Roundabout production, therefore, cannot focus myopically on the immediate profit. Rather, it invests teleologically, building the indirect means, the positional advantage, toward the ends of profits that will not materialize in the near term. In fact, as we will see, it is all the better for us that such evidence is hidden from the rest of the investing public who focus on the seen and impatiently gobble today's marshmallows. Their impatience makes them blind to future potential, tomorrow's profits that are yet unseen but can, if we know where and how to look, be foreseen. Indeed, Austrian investing 2, like Austrian investing 1, is all about the straightforward plan of attack comprised in this audiobook, being patient now in order to be strategically impatient later. Siegfried, the Dragon Slayer. The telltale sign of what we are seeking is highly productive capital. From a Bombaverkian perspective, we know that the most productive capital is also the most roundabout capital. In a physical sense, the result is obvious. Bombaverk taught us that we can always find technological ways of producing more output with our inputs, if only we are willing to wait longer. Yet I want to go further and claim what is not so obvious, perhaps even to Austrian listeners. The most profitable capital structures will tend to be very roundabout as well. I am focusing here on the Austrian model of capital and production, that we have understood in teleomechanisms from the conifer to the caterpillar and the strategy of Robinson Crusoe, acquiring later-stage advantages of efficiency through present-stage disadvantages, roundaboutness. In this audiobook, I have developed a code word for highly productive roundabout capital, a name that embodies the best of the Bombaverkian approach, Siegfried. As we recall from our parable of Nibelungenland in Chapter 7, there is something special about Siegfried, joyous in victory, slayer of dragons, entrepreneurial hero, which allows him to provide the best products to consumers with great efficiency, as his trees and pastures and goat herd flourish, thanks to his exquisite Wunderhorn playing. Like Henry Ford, with time Siegfried amasses a roundabout capital structure to make products that people want to buy, when they want to buy them. Therefore, we know that the mark of a true Siegfried is a high return on investment capital, ROIC, best calculated by dividing a company's EBIT, operating earnings before interest and tax expenses are deducted, by its invested capital, the operating capital required to generate that EBIT. Wisely, Siegfried continually reinvests his profits into his business, becoming increasingly more roundabout, instead of pocketing the profits by paying out high dividends to himself or just accumulating cash. He is driven to act by what he sees as false prices on his factors of production. His capital and other costs are just too low relative to the prices at which he can subsequently sell his finished products. To put it simply, His enterprise can transform dollars spent on inputs into dollars earned from customers at a much higher rate than he could earn by lending the money out. A true entrepreneur, Siegfried finds those false prices to be, in Mises's words, intolerable. When he sees them, he has to act, which ineluctably makes him become increasingly roundabout, as he is continually building new roundabout capital from square one, and therefore even more efficient in the future. While driven by his ends, profitability, he takes aim on his means, the tools of higher-order capital goods. Most important of all, what truly makes Siegfried a Siegfried is that he is not all that sensitive to interest rates. His profitability is not terribly contingent upon marginal movements in everyone's time preferences or the central bank's imposition of artificial interest rates. Of course, Siegfried is not perfect. When there is a big credit collapse and a liquidation of assets following a period of monetary distortion, Siegfried will see a decline in his ROIC. Even he lost a little in 2008. But his capital likely remains profitable and productive, well above his cost of capital, even if the central bank should suddenly and sharply raise interest rates in the thick of a boom. After such a surprise move by the central bank to take away the punch bowl, the Günthers of the world will be crushed, as their bloated enterprises were utterly dependent on the artificially cheap credit of the boom. They will be forced to scale back operations or fold altogether. In contrast, Siegfried will be okay, as his business model remains fundamentally sound. In the mass liquidation of the Günthers, the crashing prices of various business inputs may cause Siegfried to regret some of his purchases made at the height of the boom, but that will be a luxurious position compared to many of his peers. Siegfried is akin to the conifer, as he willingly turns his back on the fray of fast growth that often exists only because of the artificial fertilizer of distortion, and thus is overlooked by those who have no way to appreciate what he is constructing. They are mesmerized by the fast, but likely unsustainable growth of the angiosperm hairs. With an intertemporal perspective, Siegfried cedes what looks like the prime places stampeded with competitors who race for the win, and instead he happily retreats, Wunderhorn in hand, to the rocky places, where the growing is hard at first, as he forgoes his profits today to build his tools of later efficiencies. Yet to perseverance and tenacity and an intertemporal view come the payoffs, rewarding those who are not obsessed with today and instead have a depth of field perspective. Yes, Siegfried will grow more slowly now, so slowly that he may not appear to be growing his profits at all, as he amasses his roundabout capital structure. But when the time is ripe, he will emerge with the greatest advantages, and when the field of competition is cleared by the wildfire that destroys unhealthy, malinvested growth, he is still standing, even ready to advantageously invest more. His slow but deliberate roundabout growth has given him the structure he needs to accelerate later on, to kick into high gear and outperform the rest, the tortoise that morphs into a hare, and then surpasses the mere hare. To move from our fable to an operational strategy for the real non-Wagnerian world, note that Siegfried qualifies as our investment ideal because of the first of two criterion, high ROIC, which prompts him to keep reinvesting profits into his capital structure to become even more efficient and eventually grow. This pattern explains why we should expect a strong correlation between above-average returns and a roundabout capital structure, even though such a connection is not usually made even among Austrian writers, and this expectation is confirmed by data. High ROIC firms show consistently and significantly greater increases in their invested capital compared to non-high ROIC firms. Academic Austrians tend to view above-average returns, what they would call pure profit as opposed to mere interest earnings, as due to superior entrepreneurial vision, while capital roundaboutness is handled in a separate equilibrium analysis of interest rates. Yet I claim that in the actual market, we should expect these two Austrian concepts to overlap substantially. Consider, the entrepreneur who foresees a profit opportunity in the distant future and who patiently reinvests earnings into his business year after year in anticipation has a much greater opportunity for, eventually, posting an enormous ROIC than entrepreneurs who are engaged in short-term projects. The fewer the rings spanned on Bambawerk's Jahresringe, the more commoditized the business. Thus, while there may be no direct cause and effect relationship between capital roundaboutness and above-average returns, once we think through the actual forces governing them, we come to expect an observed ex-post correlation between the two. As Austrian investors, by which I mean capitalistic investors seeking to accumulate productive capital, as opposed to the more common mere gambler investors seeking to exploit changes in prices on title to capital, we have two basic choices of roundabout paths. One path is to go the Siegfried route ourselves, as that other ideal Austrian entrepreneur Henry Ford did when he doggedly amassed factories of production to build his own self-contained, ever deeper, and more productive capital structure. We too could mimic Siegfried and bring together our own factors of production in such a way that allows us to be similarly roundabout in our production as we discover and exploit what to us are